Now we move into the final learning objective, risk and qualitative factors in capital budgeting. Capital budgeting decisions should not be based solely on numbers. Managers must also consider risk factors such as inflation risk, cash flow uncertainty, and liquidity risk. They also consider qualitative factors such as safety, environmental impact, product quality, and community influence. Sometimes qualitative factors can justify an investment even if the financial return is slightly lower. Let's consider some key risk factors. Inflation risk reduces purchasing power and affects future cash flows. Cash flow uncertainty means expected cash flows may not occur as planned. Liquidity risk means some assets are difficult to sell quickly, increasing risk. Managers can adjust cash flow projections or adjust the hurdle rate to account for these risks. Qualitative factors include safety, quality, environmental impact, and community influence. These factors are harder to measure but still matter. For example, an investment may improve safety or reduce environmental harm, improving long-term reputation and reducing legal risk. Managers sometimes adjust cash flows or hurdle rates to reflect the economic impact of qualitative benefits. Let's consider the costs of investing in the juice extractor we covered earlier in the chapter. The initial cost was $4,000 with an annual cash flow of $3,000, a hurdle rate of 20%. Early in the chapter, we've computed a net present value of $2,318. Firms may reduce future cash flows to reflect inflation or uncertainty. They may also adjust the hurdle rate upward for additional risk premiums. In this example, the hurdle rate adjustments include plus 3% for cash flow uncertainty, plus 4% for liquidity risk, minus 2% for qualitative benefits, such as health-conscious impact. This results in an adjusted hurdle rate of 15%. Then the project's net present value is calculated using the adjusted assumptions. Now let's revisit the net present value calculation using the adjusted hurdle rate, which resulted in finding new discount factors from our present value index. We calculate the cash flow annually by the new discount factors, and in this case we now come up with a net present value of $2,546, which makes sense because our new hurdle rate is lower than our previous hurdle rate of 20%. Meaning that we've exceeded the hurdle rate by an even greater amount. Now let's complete learning activity 810. Describe how you might mitigate risk factors like inflation, uncertainty, or lack of liquidity in a net present value computation. Possible answers might include lowering projected cash flows, increasing hurdle rates, adding risk premiums, performing sensitivity analyses, requiring shorter payback periods, or including contingency assumptions. Pause here and complete the problem. Check your answers with the solutions provided in the back of Chapter 8.